$500 per month raise without asking your boss. And I'm excited about this webinar and think that it has three main topics and areas of interest that are key to winning financially and having more money in your pocket so you can succeed financially. So let's get started. If you guys have questions along the way, then type those down in the message and I will respond to those. So you may have heard a little while ago that there was an Equifax data breach. Now, Equifax is one of the three credit bureaus. There's Equifax, Experian, and TransUnion. And so that means that they have all of our information. They have our social security numbers, they have our credit cards or any loans that we have, all the information that we want hidden or don't want thieves to have. Equifax, Experian, and TransUnion have. And so there was a breach, which means there were some people that hacked into their system and stole 143 million Americans and 100,000 Canadians' personal identification information through this hack. So because of that, we want to make sure that we are monitoring our credit and making sure no one is signing up for cards or for loans in our name or hurting our credit in any way, because that will cost us a lot of money. So we're going to talk a little bit about how to do that and why protecting your identity and credit is so important. So a FICO score is basically a statistical number that depicts a person's credit worthiness. Lenders use this score to evaluate the probability that a person will repay his or her debts. So it's a 3-digit number and it ranges from, as you can see on the screen, 300 to 850. So not very many people have 300. That's the worst you can have. Even people that start new credit aren't going to have that. I'm not sure what you have to do to get down there, but 300 is the low, and then the best score is 850. And then the higher the score, then the more financially trustworthy you are, and the more the better terms you can get, the lower interest rates, the more you can borrow, etc. And so you're more trustworthy credit-wise as you're closer to 850. So that's what we're all trying to get to. And we'll talk about why this is so important. So who uses this credit score? Well, a lot of us know that financial institutions like credit card companies, or if you're going to get an auto loan or you're going to get a home loan, a mortgage, those types of things, they'll use it. But what people don't realize is that there's lots of other people who use this credit score. And so landlords may use it. And if you have lower than a certain credit score, then they won't rent to you. Auto insurance, which I'm going to show you next, is huge, costs a lot more money just because you have bad credit. Home insurance, life insurance, medical insurance, even utility companies can cost you much more because of your low credit. So it's not just the financial institutions that are looking at this. And even employers, there's many employers that won't hire people with poor credit. And so just to give you an idea of what this might look like, here is an example of the premium decrease or increase based on different scenarios. So hopefully you can see this, and I want you to look on the left side. You can see this premium decrease in these white boxes here. And so if you have the standard premium that you're paying for your auto insurance, well, it decreases, it goes lower, it costs less for you if you are a homeowner, if you increase your deductible, if you bundle your insurance, and then if you get married, because apparently we're more conservative drivers or better drivers are getting less accidents if we're married and care about somebody. So what causes your premium to increase? You look over here, I'm not going to read all of these, but you have one moving violation and it goes up. You reduce your deductible from 500 down to a 0. You have a not at fault accident, etc. So it goes all the way up. And then I want you to look on the right side in the middle there, the 1100. You can have 2 at fault. So you're at fault accidents, and it says your premium increases $1,100. Next is add a teen, which is $1,500. I added a teen a couple of years ago, and my other teen is going to be added here in a month, so that's not good for me. The next one is have 2 DWI 1750. But what's the number one thing that will increase your premium? Having poor credit. That is crazy. So if you have bad credit, then everything costs more money for you. And this is a perfect example. All of these things can contribute, but even having 2 DWIs or adding a teen or having at-fault accidents don't raise your premium as much as having poor credit. That is why it is key to lower, to lower these costs to increase and improve your credit. That's why we want to do this. So there was a study done that took all of these things into consideration that we just talked about, from auto insurance and home insurance and life insurance and utility companies and all these different things, the borrowers. And they said, based on all of these expenses, giving two families that look identical, what would it cost extra based on having lower credit scores? And so this is an example. So if you have 760 to 850, again, it ranges from 300 to 850. So we're on the top end here. 760 to 850 is ideal. You get the best rates, the best terms, and pay the lowest interest. 720 is a good score, but even if you have 720, you're paying $100 more per month in general for all of those different things that we talked about that were in that bucket. If you have 680, it's $300 more a month. 640, $600 a month. And if you have 580 or lower, it's costing you over $1,000 per month on average as the same individual or family that has a 760 FICO score. So hopefully you can see that improving your credit score can save you hundreds of dollars a month. If you have 640 and you go up to 760, that saves you $600 a month, which just that alone would be similar to giving you a raise of $600. And so this presentation is entitled How to Get a $500 per month raise Without Asking Your Boss. And the first way is to improve your credit so that you can pay less in interest, pay less in insurance, pay less in utility costs, pay less in a lot of different things. You get preferential treatment when you have better credit. So that's more money in your pocket. So a question to you would be, do you know what your score is? If you're not sure what your score is, then you don't know where you fall on this, right? How much is it costing you per month to be below the 760 to 850 ideal? So I'm going to show you later how to get a free credit score as well as a free credit report, because we want to make sure that you understand and know what's on your credit report to know what's lowering your credit and how you can improve your credit so that you can save possibly over $100 or over $1,000 per month. So what are some things that affect the credit score? Well, if you have a better credit score, then they expect more from you, right? With great power comes greater responsibility, or whatever with Spider-Man. So you have a better credit score if you look over there on the right side, 780 versus somebody with a 680 in the middle. Well, if you maxed out your credit card, then you'd only get hurt 10 to 30 points if you're 680 score. But if you're 780, where you're expected to know better and do better, it's going to hurt you 25 to 45 points. So that's, almost double or more getting hurt for the same thing. 30-day late payment, you can see 60 to 80 points if you got a 680, but if you got a 780, it's going to hurt you 90 to 110 and all the way down. So it's hard to build your credit. And if it's, it takes a while, it doesn't just happen overnight, but as you improve your credit and get better and things cost less for you, you have to stay on top of it. And that's why we want to track our credit, and we want to look at our credit report and see if there's anything on there that's damaging it. Maybe somebody used your name and information from the hack and signed up for a credit card you don't know of, or a cell phone plan or something, and they're not paying on time, and you don't really know what's going on because you haven't checked your credit report. So we're going to talk about how to do that because you don't want that happening to you, because little tiny dings will knock you down if you have a great credit score. So we're going to talk about what's involved in your credit score. There's 5 different main areas that make up your credit score that determine your credit worthiness. And like I said, it doesn't happen overnight. Takes kind of years to get this going. And we're going to talk about each one of these. And so the biggest one is payment history, 35%. And we're going to delve into each of these. The second is the 30%, how much you owe. 15% is your length of credit history. The longer you have, then usually the better. And then the credit mix you have, and if you're having new credit. So what does this mean? Let's look at payment history, the 35%. So how many number of late payments do you have? How recent were they? Was it last month or was it 2 years ago? How severe were the late payments? Was it like on your mortgage or credit card? Are you 30 days late? Are you 60 days late? Are you 90 days? And so obviously 60 days or 90 days late on a home or whatever it is, a car payment, is more severe than being 30 days late. Number of accounts currently past due. Do you have one account past due, but you have 7 others that are on, not past due, they're good standing, or are 6 out of the 7 past due? And then how old are these accounts? If you've had this account for 20 years and then you're past due 30 days, and this is the first time that's ever happened, that's going to be different than if you've had the account for 3 months and you're already 30-day past due. So all of these go into this 35% bucket of payment history. And you want to make sure you are paying on time, you're not late, and that's the number one thing that's going to help your credit. All right, this next one, the amount owed, is how many accounts do you have open? So, having more accounts can build credit, but you don't want a ton of credit cards, for example, because then that provides an opportunity for you to get into more trouble. If you've got 10 cards with $10,000 on each one, you got $100,000 available to you. That's a lot different than having 3 with maybe $5,000 on each and you only have $15,000 that you can get in trouble with. And so how many accounts are open? How many have a balance? And then that bottom left one there, ratio of balance to credit limit or the initial loan amount. So if you get a car loan and the car loan starts out at, say, $8,000, and you still owe $7,500, then you haven't really done much to pay that down. You've only paid down $500. But if the initial amount was $8,000, now you only have $2,500, then that looks better, right? You're going to have a higher credit score with that because your ratio of what you owe to what you borrowed is lower. The same thing on credit cards. What we recommend with credit cards is that you are 30% or lower use of the total available credit. So if I have a credit card and let's just use easy numbers and I have $1,000 available to me, then the maximum I want to have on there is $300. If I have $900, then that shows that I'm maximizing the use of the credit card, showing less maybe discipline on my end, and so it hurts my credit. So if you have 30% or less, $300 or less on a $1,000 credit card, that shows, hey, he can show restraint. She knows how to manage her money. She's using it, but she's not going overboard. But if we have 5 credit cards for $1,000 and all of them are maxed out at $1,000 and a couple are even a little bit above $1,000, that does not look like we know what we're doing with our money. So that's really going to ding and hurt our credit. So that's really important to keep our ratio under 30%. And then that's the bottom right one, the overall use of debt is just the total amount of debt available to us, the credit available to us. What are we using of that total amount? So the next one is this length of credit history. So in the middle there, you can see the higher the average, the higher your score. So the longer your history length, 20 years, 25 years, 30 years is going to be better than 6 months, 1 year, 5 years, right? So what's the average of your revolving and your installment accounts? And you want to then keep your older accounts open. So a lot of people say, hey, I have this credit card. I'm wanting to close these things down because I'm trying to fix my credit. And should I close this credit card? And then I say, well, how long have you had it? And they're like, well, it's my oldest account. I got it when I was in college. And I've had this for 15 years. And I say, well, what are the other cards and things you have? Well, I just got this other one that's a better card that I like better, and I've had that for 2 years. Well, if you cancel and close the one that you've had for 15 years, now the average amount of time for your credit history shrunk tremendously, right? You used to have 15 years, and now that one's gone, and it goes down to this 2 year. And so you don't have to use it. You can cut it up, just don't close the account. You keep those older accounts open to lengthen the amount of time for your credit history. So hopefully that makes sense. You want a longer credit history. And then on this next one is the types of credit. And so you have revolving lines of credit, which are your credit cards. You have installment loans, which would be kind of like a mortgage or a car payment. And then you have minimum payment activities. That means, are you just paying the minimum, or are you paying more than the minimum? How are you paying towards your debt? Are you're paying on time, but are you paying only the minimum amount? And then the type of lender. So you want a kind of a good mix. That doesn't mean go out and get a bunch of, get a car loan and all these different things, but usually somebody's had a car loan maybe in their life, or a credit card or two, or maybe a personal loan, maybe a student loan. Later they get a mortgage loan. And so there's different types of credit that you've qualified for, and then you pay on time. You pay more than the minimum. You pay things off early. You keep your balances lower, and that shows and proves that you're a good borrower, right? That you are creditworthy. But the type of lender is important, and I'm going to get on a soapbox here for a minute, because a lot of people like to get store cards, right? They go to shopping mall, and these places are offering a store card for 20% or 25 or 30% off discount on that day's purchase if you sign up for your Kohl's card, or if you sign up for your Old Navy card, or whatever it is. And that really dings your credit because it's new, which we're going to talk about next, the length of time, it's brand new. But it also is the type of lender that's not seen favorably, having these store cards versus having a major like Chase Bank card, or a Citibank card, or Discover card. Those cards are seen, those types of lenders are seen as better to borrow from and to use than store cards. And so if you keep signing up for these different types of store cards just to get that 30% off, that's really actually costing you more than that in the long run, because it's hurting your credit, and then everything is costing you more. So please don't sign up for all those store cards. And if you've done those recently, and those aren't your super old cards, then I would cut those up and close those accounts, most likely. Depends person by person, but that's usually. So your last 10% is the new credit. And that's, again, how many have you opened in the last 12 months? What are your recent loans, especially in the last 6 months? And so again, if you're, every time you sign up for a new store card or something new, it's lowering the length of history you have. It's shortening it, because now you have something new that's only been open for 1 month. And it's dinging your credit because you have an inquiry. So on the left side, the number of inquiries or hard pulls for different purposes ding your credit. So if you want to go get a phone and they're like, well, we need to check your credit, then that's going to lower it for a little bit. No, we need to check your credit for car. That's going to ding it. For this credit card, that's going to ding it. For the store card, that's going to ding it. So you don't want to go around and have everybody checking your credit. Now, what people don't understand is that you do, though, want to comparison shop if you're looking for, say, a car loan or a home loan, a mortgage. You want to get 3 or 4 different lenders to show you what their rates and terms will be. And so I'm a loan officer, and I help people with their mortgages, do purchases or refinance. And by the way, rates are super low right now. So if you haven't done that, you want to look into that. But I tell people that I'm helping with, I say, you want at least 3. I do 3 or 4 different lenders, maybe a small bank, a large bank, a mortgage company, which is like what I work for, and maybe, say, a credit union, and look at the different terms and rates that they have and they offer you, and you want to go with the best one. And they say, well, won't that hurt my credit? And it doesn't. It does for the one, But having 4, 5, 6, or whatever people pull your credit for the same purpose, the same reason, which would be refinancing your mortgage, only counts as one because they want you to go and comparison shop. So if you get it with 4 different people or one person, one lender, it's going to ding your credit the same. Hopefully that makes sense. Again, if you have any questions, write those down there and I'll try to answer those. So those are the 5 areas that you want that are part of your credit score to kind of show, are you a good credit-worthy borrower and what rate should you get? And all of these go into that 3 digit number of between 300 and 850 to give you a score compared with everybody else. So these are the things that can improve your credit score. The number one factor, top left, far and away, is to make your payments on time. Don't be late. Now, that doesn't mean that it's 5 days late, right? If you have a credit card, and I have a few credit cards, if I use them, I pay them off in full every time. I don't use my credit card to buy stuff I couldn't pay cash for. So I never carry a balance. I always pay in full on those. I also don't do, excuse me, auto loans. I pay cash for my cars. I have a car replacement fund that I put money into, and then when I'm ready to get a new car or a used car, because I don't buy brand new cars either, I have cash for those. But if I did have a card, or people that I know that have, say, a credit card or a car loan or something, and they are 5 days late, it comes due and it's supposed to be due on the 5th of the month, and they don't pay till the 10th of the month. Well, there could be a late fee of, say, $35 or something, but that's not going to go and hurt your credit score. It only hurts your credit score when the lender reports the lateness to the credit bureau agency, which again is Equifax, Experian, or TransUnion, and that usually only happens when you're 30, 60, and 90 days late. So if you're a mortgage or a car loan and you're 30 days late and you haven't paid in 30 days, now that's going to go as a 30-day late on your credit report, and it's going to hurt your credit. If you're only 5 or 10 days late and then you paid in full your payment, then you're going to have to pay a late fee and maybe extra interest, but it's not going to go on your credit. So just wanted to make that clear. But the number one factor is to make all of your payments on time. The second one down there on the left is to make more than the minimum payment or paying off your credit cards. We're going to talk about how to pay off debt in a little bit. And then you want to keep your loan balances low. Remember, 30% or lower is optimal for improving your credit. So it doesn't matter that you have the loan, it just matters that you have a low balance compared to what your available credit is. The top one on the right, we talked about keep old accounts open. The next one, limit the amount of credit cards. And then the last one, don't open unnecessary revolving credit accounts, especially those horrible store cards that I hate. All right. So we have a lady here climbing up either side, and the one on the left is 650, and there's different things I can send that to you if you want to look at that is keeping her at 650, and then the high achiever 800 is over there doing all these other beneficial things. And so the beneficial things are on the right side there. Those high achievers, 96% of them, they don't have any late payments. Those 30, 60, 90-day lates. The right side, they use on average only 7% of their credit limit. So I said 30% or lower, they're only using 7%. They're not strapped, where the improvers maybe over there using 80% of their credit. High achievers are only 7%. They owe low amounts on their credit cards, lower than $3,500 versus tens of thousands maybe for other people. And they have a long credit history, right? The length of 25 years or more. So as you move towards those and climbing the ladder of being a high achiever, this mountain, those are some of the things that you want to look for. So as I stated before, these are the 3 credit bureaus, and this is key to know because there's fraudulent companies or websites out there trying to pretend like they are annualcreditreport.com. Annualcreditreport.com. This is where you get your free credit reports from Equifax, TransUnion, and Experian. So if you just look up free credit report, then there's a website called freecreditreport.com, and that is not free actually. And they try to get you to buy stuff and things. So remember that if you want to pull your credit for free, and you do, you go to annualcreditreport.com. That's what you want to do. So I recommend going there. This is maybe a little bit of homework, but it's well worth doing this to make sure that you're keeping more of that money in your pocket, giving yourself a raise. You want to go to annualcreditreport.com. And if you've never done this or haven't done it in over a year, I recommend pulling all 3 credit reports. So you can get a credit report one a year from Equifax, Experian, and TransUnion. So if at the beginning I say pull all 3 and look and see if there's anything, because once in a while there are some lenders that report to one agency or one broker, and the other ones they don't. And so maybe they report to Experian and they don't to Equifax and TransUnion. So you want to just make sure that you see everything that's on your credit report from all 3 credit bureaus. So you pull those, and then after a year, you can start pulling them once every 4 months, right? So Equifax maybe in January, and then 4 months later you pull Experian, and then 4 months later you pull TransUnion, and then 4 months later it's time for Equifax again, and you just go in a circle. So every 4 months you can kind of pull those and see what's on your credit report. Now another easier way, I think. Well, let me say this first. A study showed that 5% of consumers had errors on one of these reports, things that were not theirs that were causing a lot of headaches, right? Dinging their credit and causing them to pay more money that they shouldn't have done. And so, there's lots of stories out there, but I had a friend actually that pulled their credit report for free, and they had a judgment on the report, which wasn't his, and it had been on there for a couple of years. And so I'm not sure how much that cost him in increased premiums and other insurance costs and things, but probably thousands of dollars. And so we need to be vigilant and know what's on there. And then if you have issues on the credit report that you say, hey, this isn't mine, I don't even know what this is. If you're a student, you'd want to talk with your parents maybe and just make sure, or if you're married, your spouse, just, hey, do you know what this is? I don't know what this is. And if they don't either, then you go to myfico.com, and they have resources there to dispute this error and get it corrected and get your score fixed. You also want to check your children's reports if you have children. I have 5, because if someone got their Social Security card or number, they could have been part of an identity theft, right? It's easier to fix now than later when they're trying to get some other loans. And a lot of times the kids or children are the target because people aren't checking their credit reports. They're just checking. They're like, well, we don't need to check theirs. They don't have any credit. Well, what if somebody in their name signed up for something? You need to kind of check that and make sure that's there. So there's a couple easy ways to do that, and you can pull your free credit report, but there's a couple easy ways that kind of show you what's on your credit report also. And one of those is creditscorecard.com. A couple other ones are like Credit Karma or Credit Sesame. I'm actually signed up for creditscorecard.com as well as creditkarma.com. Some of your credit cards that you have may offer free credit monitoring and or allow you to kind of see what's going on, and once a month they update your score. So I get on creditscorecard.com, which is through Discover Card, as well as Credit Karma, and I get an update and see, and if there's a ding to my credit, then I would go in and actually pull my real credit report, look at it, and then dispute that charge because it wouldn't be mine. And so it's easier, you can pull your free credit report every 4 months and things. Again, I would go in and pull it, all 3 of them right now if you haven't done that in the last year. But then sign up for 1 or 2 of these credit monitoring that can kind of let you know if there's a ding. The other thing you want to know, again, is that 3-digit score. So your credit report that you pull from annualcreditreport.com for free is only going to show you what's on your credit report. It's not going to show you what your score is. And lenders use different types of scores. And so the FICO score 8 is what typical lenders use for doing a car loan or checking for cell phones or doing a mortgage. They use FICO score 8. And so the only place that I know of to get that score for free is this creditscorecard.com, and you go there and register to through Discover Card, and it will allow you to have that for free. It's going to invite you to sign up for their credit card, but you don't have to do that. So you can say, no, I don't want to do that, and you can just sign up for this to get this score. Credit Karma, Credit Sesame, etc. They use what's called the FICO Vantage score. Vantage 8 is where they are, but that's not totally accurate compared to what the lenders use, which is the FICO 8 score. And so there's going to be some difference in your score. Like, again, I have Credit Scorecard, and then I have the Vantage 8 Credit Karma, and those scores are different, but the one that's most accurate is going to be this Credit Scorecard. So hopefully that makes sense. I'm going to show you my recent FICO score from creditscorecard.com. And you can see that I have over here on the top left, it says that it ranges from 300 to 850. My score is 816. You see these 5 areas over here in the green that's exceptional or very good. And those are the 5 areas that we talked about, right? And so how many accounts do you have open? What kind of it's the credit mix, this 10%. The next one down is your length of credit. So this showed 20 years. That's 15%, excuse me, of your FICO score. The third one down is kind of new credit, which is the 10%. I haven't had any in the last 12 months. The next one is kind of how much are you using? So the amounts owed, you should be 30% or lower. I had 7%. And then how many payments are you late? That's 35%. Are you doing on-time payments? And I don't have any missed payments. I'm always on time. So I, have followed my own advice and done what I needed to kind of get where I need to be. So I'm going to share my screen real quick because I wanted to show you, and hopefully you will be able to see this. All right, let me know if you can see my screen. Can you guys see this screen that's annualcreditreport.com? Okay. So this is where you go again for your free credit report. And you can see that they underline the only source for your free credit reports, authorized by federal law. So there's lots of people that try to, again, copy and do that. But Equifax, Experian, Trending, you go here and you can click on request yours now, and you go through and they're going to ask you questions to make sure it's you. So, what was your first car you purchased, or the car you got 3 years ago? What type was it? And all these different things to make sure it's you. And if you don't answer correctly, then you have to wait a little while and try again, or you can call in and try to get that done. And then the Federal Trade Commission, they are the ones that get a lot of complaints from different people, and you can kind of see this free credit reports, and it says visit annualcreditreport.com, and it talks to you in here about a warning about imposter websites and not going after those freecreditreport.com type things. And so again, I just wanted to make sure and hit home that the place you get your free credit report is at annualcreditreport.com. Then again, I told you to go to myfico.com, which if you have errors on your credit report, then you can get those off. And so you see down here, fixing credit report errors, and then how to initiate a dispute online. Here's an example of what you can do for communication. And so it kind of gives you an idea of what to do if you have something on there. And then lastly, this is the Discover. It's creditscorecard.com login, and it says it alerts you to unusual activity. Checking never impacts your credit, so them checking and making sure and monitoring isn't like a hard pull. It's not dinging your credit. Same thing with Credit Karma and Credit Sesame, etc. That doesn't hurt your credit. It refreshes every 30 days. And then the last bullet point here, free, even if you're not a card member. So again, they're going to try to sign you up for the card, but you don't have to do that in order to get that. So I'm going to end sharing and go back to my presentation. You guys see my presentation again? Hopefully. All right. So to finish this section off, this is the first. Remember, I said there's going to be three main areas to get ways to get a $500 per month raise without asking your boss. This is the first key way to getting that raise, is to improve your credit. I strongly encourage you to pull your free credit reports at annualcreditreport.com, to get a free credit score at creditscorecard.com, and fix any errors you find on there by going to FICO.com. And if you find different things, you can add a freeze on your credit and other stuff. If you want to know more about that, please contact me. So this is the first and best way to get a nice raise without asking your boss. Again, it could cost you over $1,000 a month by having bad credit. And if you don't know what your credit score is, or if there's errors on your credit report, then you need to figure that out so it's not costing you hundreds of dollars a month. The second key way to get a raise is to eliminate your debt because of how much money you're putting and paying towards interest. And so who can relate to this picture here? It's a visual of what debt looks like in our lives for many, many people. I'm also, I do financial counseling, and I have clients now that, they make a lot of money. One's a doctor, and they have tons of credit cards and other loans. And they have like $175,000 in credit card debt. And he makes a lot of money. So it doesn't necessarily matter how much you earn. It more matters how much you choose to save and how you choose to spend. And so you want to build wealth, you want to spend less than you earn, pay yourself first into savings and put that aside. And if you do that, then you don't have to have this giant debt monster after you all the time. So we're going to talk about debt, how to get out of debt, etc. But first, why do we go into debt? What is the purpose? I want you to ask yourself, why am I going into debt? Or are you? Maybe you say, I don't go into debt. And for the reasons that you're going into debt, are they because these are needs, or are you going after wants? And so you got the person up here, I want it now. She wants the Oompa Loompa now from Charlie and the Chocolate Factory. Maybe we want our Starbucks coffee every morning. We want that awesome new car. We need the brand new iPhone 11. We need to go out to eat all the time or to go to movies. These are all wants, not needs. And as it states in this next quote here by George Clason, that which each of us calls our necessary expenses will always grow to equal our income unless we protest to the contrary. So like this doctor friend of mine, maybe, he makes maybe $300,000 a year, but he's living paycheck to paycheck. He just has more debts, more stuff, bigger payments for his house, bigger payments for his cars, more payments on these credit cards of $175,000. And so whether you earn $40,000 a year or $300,000 a year, our expenses tend to equal our income unless we say enough is enough. And we say, guess what? I'm going to put money aside first, pay myself first into savings, which can then go into investing, and live off the rest. In other words, live on less than we earn. That will keep us out of this debt. Again, it's not how much we earn, but how we choose to spend that money. So what are the top causes of debt? Why do we tend to go into this debt, right? Some people think it's normal. It's just a way of life. Everybody has a car payment. Everybody has debt. It's because we want things now and don't want to wait, etc. But if you're in school as a student, or if you recently were, or in the last few years, then you might have some student loans. And student loans are fine as long as you are minimizing those. And so in my classes here at NMSU, I teach a class, and one of the main focus areas is to help students minimize the amount of student loan debt that they'll have and credit card and other debt when they graduate. They don't, because a lot of times they borrow this money and then we spend it on going out to eat or buying a vehicle that we don't need, or having a pet that costs a lot of money, or all these different things that we do, buying expensive clothes or things that we want, or going on these vacations. And we shouldn't be doing any of those things if we're borrowing money and going into debt. We need to be living more frugally until we can earn more money and live a little bit better, but still within our means. So student loans, possibly, but credit cards, our auto loans, and then our saving habits, whether we tend to pay ourselves first and save or whether we're spending more than we earn. Those are really the top causes of debt. These other things like financial ignorance or divorce or medical expenses definitely happen. But for most people, it's the auto loan, it's the not saving and spending more than we earn, and it's these credit cards that we sign up for, or store cards. So let's talk about a little bit more about how we kind of spend or waste our money, and then how we can get out of this debt. So you can look here. Food away from home was number one. I have my students track their spending for a month to see where their money's going. And for one of them, they spend almost as much as my whole family of 7 on food, because they're going out to eat all the time. And so they're eating their way into student loan debt by borrowing all this money and then going and eating out all the time. And so if you tend to eat out a lot and want to decrease how much you're spending on going out to eat, or decrease how much you're spending so that you can have less debt, then that's one of them that you should focus on. So is it ever okay to go into debt? That's a question that I usually get asked. And yeah, so Robert Hales here says, debt incurred for education, and I would couch that again in only what you need for education, not borrowing a bunch of money in student loans and then buying a new car and going out to eat all the time. That's not what he's talking about. So the minimum amount you actually need to borrow for education, or a modest home, notice the word modest, or a basic automobile, notice the word basic, may be necessary to provide for a family. So education, modest home, basic automobile, right? Doesn't say anything about a bunch of expensive clothes or vacations or our lifestyle, or brand new cell phones and things like that. And I agree with what he's saying here. So we need to really decide, why are we in debt? And if we're in debt and it's a way of life and everybody's in debt, what's the big deal? Why do we even care? So why get out of debt? That's a good question. Again, a lot of people just think that's the lifestyle. Maybe their parents always had debt, their friends have debt, they have debt. What is the big deal? Well, that's like me asking, what's the big deal of having a bad credit score? Who cares? We know, because it's costing us $1,000 a month on more expensive for our insurance and everything else than our buddy over here that has good credit. So that's why it matters, because we want to keep as much money as we can in our own pockets and not spend it all to other people, right? And so we're paying more for insurance if we have bad credit. And if we're in debt, then all of our money is going to our lenders. We don't want to make them rich. We want to keep that money in our pocket and give ourselves a raise. So let me give you a couple of examples here that I think are potent, that most of us have and use. So here is a credit card. This person has $5,000 and are paying $200 a month, which is the minimum payment. And it's going to cost them, this is an 18.9% interest. Some people have 29% interest and others have lower, but 18.9 is fairly common, up to 24. $5,000 is going to take them 11 and a half years to pay this off, and they're going to pay $3,100 in interest. So for $5,000 use, they have to pay $8,100 back. That means every dollar they spent cost actually $1.62. So if they go and buy lunch for $10, it actually costs them $16.20. If they buy something for $100, nope, it was actually $162. That's what it is when you use a credit card and keep a balance and don't pay it off and pay the minimum payment. You're paying $1.62 or more for every dollar you use. Well, that doesn't sound like a good deal. So that's one reason why we should get out of debt, right? Another thing is our mortgage. everybody has a mortgage. Who cares? Whatever. No, it's costing us lots of money, and you could have a lot more money in your pocket every month if you paid your mortgage off early. So this is a comparison between a 15-year mortgage versus a 30-year mortgage. So if you look down here at the bottom, you can see a 15-year mortgage. Both of these are $200,000. The interest rate is better for a 15-year mortgage, 4% versus 4.5. The monthly payment's a little higher, right? About $350 a month. But look at this next thing. The total interest that they pay is only $66,000 compared to $160,000 for almost $65,000. So that's $99,000 more that they're paying in interest, giving to somebody else just by having a 30-year mortgage instead of a 15-year. So this shows another example of 30, 20, or 15 years. You pay $133,000, this left blue column, in interest for a 30-year mortgage. 20-year, you only pay $81,000, and then 15-year, you pay about $53,000. And so it's beneficial to kind of force you to pay less in interest to get a 20 or 15-year loan. If you don't have that and you have a 30-year loan and you're paying down and you want to pay less, then what you can also do is just pay more every month and make it automatic. So just sign it up, and instead of you make automatic payments, instead of your, say, $1,200 a month, you're going to pay now $1,400 or $1,500 a month. Automatically, it just goes and pays that, so you don't have to make that decision every time, and that's going to pay it off earlier as well. And so if on average, if you can pay an extra payment a year, then that cuts off, say, 7 years off your mortgage and tens of thousands of dollars in interest back in your pocket. Just to show you how crazy interest is and how much money is going out to the lender. And again, I'm a loan officer for a mortgage broker. So I help people get into homes and finance and refinance homes. And I share this with them so that they can pay it off as quickly as they can, because a lot of this money is going to the lender. So you can see this $200,000 payment. This is the 30-year loan at 4.5% interest rate that we just looked at. The payment is $1,013. The principal, though, the amount that's going towards paying their debt down is only $263,000, and the rest of that $1,000, which is $750, is going to interest. It just goes to the lender. Thank you. I'm loaning you some money, and each month you're going to pay me back a little bit of the principal, but you're going to pay me back in interest. And they got $750 the first month, and you can see it only decreases by 99 cents. Or $1 each month. And so that's not very good, right? In fact, if you look at the numbers there, out of the $1,000, you have about $250 principal, and then interest is $750. That's 285% interest. You're paying 3 times as much in interest as you're paying in the principal. That's not a happy thought. So my encouragement again is to use a 15-year mortgage or and pay your credit cards off in full or faster, because this is what it is, right? You feel the weight of your debt. All that extra money is going to interest and making somebody else rich, where if you didn't have that, just think of what you could do, how much you could have with no debt. All that extra interest that you are paying to other people is now back in your pocket, giving you the raise that you deserve. So how do we do this? Well, let me just share my screen and show you a funny little clip that I have here that I like. Everybody likes this one. This is Saturday Night Live skit on debt. Can you guys hear that?
Like we're never going to get out of this hole. Credit card debt, does it ever end?
I just want to make sure. Can you guys hear that? The video. I don't want to play the whole thing if it's not working. So, all right, let me try to. Well, it's up there all the way. Let me control. Let's see. All right. All right. So hopefully you can see that they make fun of this because it's an actual issue, right? People paying and buying things that they can't afford and getting into debt. And it can be confusing. People just think it's a way of life to get on debt and be in debt and make payments. So best ways is to stop the bleeding, right? Stop the digging, stop going into more debt. So first thing is to stop going into more debt. Then the next would be then to start eliminating the debt that you do have and creating an emergency fund for that. And a great website to help you put information in and then create a debt snowball, which we're going to talk about, is powerpay.org. And we'll show you an example of that. So the debt snowball is where you get all of your debts and you put it, say, in powerpay.org. And here's an example we can talk about. It's a little blurry. I'm sorry about that. But if you look over here, then this is a dentist, and then there's an auto 1 and 2, and there's a home and Discover, MasterCard, and Visa, all these different things that they have, home equity line. And then you put it from the lowest balance to the highest balance. And this powerpay.org will do this for you. And you pay the minimums to everything except that smallest balance. On this would be the dentist. You put all your extra money onto that debt until it's paid off, and then that rolls over and starts going towards the next debt, which in this case is auto 1. And then that gets paid off early, and then you roll it to the next debt. And so it's kind of this debt snowball, this debt elimination plan that rolls from one debt to the next debt to the next debt, with all of your extra money of debt going towards your debt. And so instead, a lot of people pay one thing off typically and say, oh, look, I got this extra, $200 because I just paid off this loan. What can I get now? And then they want to go buy something else, like a new couch, with another debt because they have $200. And that's a great way to just keep living paycheck to paycheck and giving all this extra money that should be in your pocket out to the lender in interest, right? Again, with credit cards, it's $1.68 for each dollar that you're paying. And so we don't want to be giving other people that money. We want to be using that. So I really recommend getting on powerpay.org and taking care of that. When I was in college, I helped families get out of debt. I went and met with them and got them on a debt elimination program that's similar to this. And so if you do this, like it showed, getting out of debt faster, in this case, these people were going to be in debt for 27.6 years. That's including their mortgage, right? And they're going to be paying $443,000 in principal and interest. Well, by doing the debt snowball and paying towards one debt and then moving it to the next, to the next, to the next, they're going to be out of debt in 12 years, and they would save $92,500 in interest and $234,000 in payments eliminated. So that's pretty awesome. And then that's the red was their old plan here. The light green was the new plan to be paid off. And then if they kept paying that payment, which is the $2,600 you see up there, into an investment account of only getting 5%, by the time they would have been paid off in the 27.6 years, they now would have $743,000 in the bank. And so you can see the difference that it makes when you're earning interest and it's growing. It's awesome. When you're in debt paying interest, then it's really a weight, right, that's on your shoulders that you're paying. So we don't want to be in debt. It's we don't want to have low credit. Those are the things that are taking money from us, and are two ways to get a raise. The third and final, and we're almost done here, only have two more slides actually, is spending leaks. And that's kind of what we were talking about before, of my students tracking their expenses and they're spending all their money going out to eat or buying new clothes or buying a too expensive of an automobile, going and getting coffee every morning from Starbucks. These are all ways that money is leaking out of our pockets and going to other places because we want things now instead of delaying gratification and saving and only buying what we can afford, right? So if we can eliminate or minimize some of these other expenses that we have, going out to eat or whatever it is, again, ask yourself, what are two or three of my spending leaks? What are things that I tend to spend money on that I could minimize or even eliminate? Maybe I can start making coffee at home instead of going and getting coffee in the mornings somewhere else and save money that way. Maybe I can bring my lunch instead of going out to eat. There's lots of different things that we do, each of us do, to kind of has these spending leaks, right? And so as we minimize or eliminate these, this is how we find extra money to really get that snowball going with the debt snowball. So if we can lower and plug some of these spending leaks, and then we find an extra $20, $50, $100, then we can add that to our first debt and accelerate that payoff, and then that will go to the next debt, the next, and then we're out of debt faster. And as we pay off our debt, then the amount we owe goes down, obviously, and so then we're below that 30% threshold, and that improves our credit, and our credit improves, and everything then becomes less expensive for us. And so the key is knowing where your money's going. It's tracking your expenses, knowing where that's going, spending less on things, plugging those spending leaks, taking that freed up money and putting it towards those debts to accelerate that debt payoff, which then improves our ability to pay on time and pay more than the minimum, and to lower us down to the 30% and improves our credit. And all of these together then is how we get at least a $500 per month raise without asking your boss, right? That's how we do it. So hopefully you will be motivated to plug those spending leaks, to accelerate your debt payoff, and then improve your credit. And I definitely want to encourage you to, again, check your credit report, pull that, sign up for creditscorecard.com or at least Credit Karma or something like that to monitor that credit and see what your score is, and then make sure you're paying on time your debts. So I will end with that, and if you guys have any questions, please put those down in the message, or you can contact me later. My email is brycej@nmsu.edu. And you can contact me, and I'd be happy to talk to you about any of these concepts, from getting out of debt, plugging those spending leaks, or improving your credit. Appreciate you guys attending. And after, if you will kind of stay on, we're going to finish this, and there's going to be a quick little 2 to 3 minute survey. If you can take that, and then once you take the survey, it's going to give you a link that gives you more resources that'll be beneficial for you on these topics. So thanks, everybody.